Alright, so hi guys, in this video I'm going to really show you how to identify the highest probability bounce trade setups. So if you follow all these very strict rules, it would reduce the number of bounce trades you take, but it would dramatically increase the expectancy and the win rates. So let's run through what makes a high probability bounce setup. There are altogether 7 things that I look at. So the first thing is stochastics. So when we go long, for long trades, we want the stochastics to be oversold. In other words, both the percentage K and percentage D should be below 30 at the reversal candle. And the reversal candle is the candle that bounces off the moving average. So at that point of bounce, we want both lines to be below 30. Or it could recently be below 30 and it's now crossing into bullish territory. In other words, the percentage K is crossing above the percentage D. That is also valid. For short trades, it's the opposite. When you're going short, you want the stochastics to be overbought. So again, both lines must be above 70 at the reversal candle, or recently above 70 and is now crossing bearish, where the percentage K is crossing below the percentage D. And again, I'm going to illustrate it in the charts in a short while. So let me just run through everything and I go through them step by step once again. Next, the MACD. So for bounce 50 and bounce 100 or 150, we use the MACD 50-100 line. And again, for long trades, we ensure that the MACD is bullish. Okay? Now, if it is bearish, it should have not crossed bearish within 5 candles. In other words, it should have crossed bearish more than 5 candles ago, or 5 candles ago or more. For short trades, MACD should be bearish. Or if it is bullish, it should not have crossed bullish within the last 5 candles. Okay, so 5 candles or more is fine. Next, we look at wave patterns. So for going long, we want to see an uptrend wave. An uptrend wave means price is making higher lows. That means the reversal candle is making a higher low than the previous swing low. Or the EMA, the moving average that is bouncing off, has been tested before. When going short, we want to see a downtrend wave where the price is making lower highs. Okay, so in other words, the reversal candle is a lower high compared to the high of the previous candle. Or, again, the moving average must have been tested before. Next, we want to see smooth retracement. So what does this mean? So let me draw for you an example. So if I'm going long, this is the moving average, right? That's the moving average. Could be a 50 moving average or 100 moving average. And we have got what we call the impulsive wave going up. And this is known as the retracement wave or the corrective wave. So it's retracing, all right, and then it bounces off. So this is the bounce, okay, and then it makes a new impulsive wave. So again, this is the impulsive wave. This is a retracement wave, impulsive wave, and this is the excuse me, the retracement wave. Okay, and again, this is where we have the bounce. So we are going to enter here at the bounce. Okay, so what I'm saying is that this retracement, let me put it in red. Okay, so the retracement, okay, before the reversal candle should be a smooth retracement. And what I mean by a smooth retracement is I want to see that the candles are making lower highs and lower lows just before the reversal candle. So the candles are making lower highs and lower lows. Again, I'll illustrate it on the chart in a short while, so you better understand, right? Now for short trades, it is the opposite. So if I'm going short, this is the moving average. And this is the impulsive wave going down, right? And that's the retracement wave, where it again finds the reversal candle and bounces down. So this is where we go short, right? This is where we sell. So the retracement wave before the reversal candle is over here. This is a retracement wave, right? So when we go short, I want the retracement wave again to be a smooth retracement. In other words, price is making higher highs and higher lows before the retracement candle. So again, I will show you a chart and then explain it one more time. Next, I want to ensure that when the price bounces off the moving average, whether it's the 50 or the 100 moving average, I want to ensure that it's a strong support. So how do I know that it's a strong support that can be reliable? Well, number one, I want to ensure that the moving average has been tested before, preferably tested at least twice prior to the bounce. Okay, so in other words, if it's bouncing here, right, it's bouncing off the moving average, I want to make sure that it has been tested before. The moving average has been tested to be strong before, and I want to see at least 2 candles testing the moving average before the bounce candle. All right, similarly, if I'm going short and I'm entering here, I want to see that the moving average has been tested before by at least 2 candles. Okay, now, or, I use the word or, I want to ensure that the support level, if I'm going long, the support level over here is a Fibonacci level. It's either a 61.8% Fibonacci level or a 50% Fibonacci level. Or the place when the price is bouncing off the moving average is a strong horizontal support or resistance. So if I'm going long, obviously, I want the bounce to be a strong support. Okay, a support level. It must be a support level. Okay, if I'm going short, I want it to be a strong resistance level, a horizontal support or resistance level. So bear in mind, it is either this or this or this. Okay, it doesn't have to be all three. As long as one of them is present, I have a strong support. Okay, next, if I'm going long on a stock, I want to ensure that the S&P 500, the overall market is bullish, right? Preferably it's above the 20 exponential moving average, right? And or above the 50 moving average. Okay. Next, I want to ensure that the sector trend is bullish as well. So whatever stock I'm looking at, if I'm going long, ensure that the sector or the industry chart is bullish. If I'm going short, I want it to be bearish. And again, ensure no earnings release in the next 7 days. All right. So I know I've thrown a lot at you, and it may be a bit hard to focus on so many things at the same time, but I suggest you print it out, use it as your checklist. So whenever, before you enter a bounce trade, ensure it checks all the boxes. All right. So let's run through this one by one using a chart example. Okay. So this is an example of DNKN. So this was a potential trade setup on the 28th of November. Okay, so let's take a close look. First of all, you can see that this is a 2 candle reversal pattern, right? 2 candle reversal pattern with a confirmation candle, right? So we must also have the valid 2 candle reversal pattern or a single candle reversal pattern followed by the confirmation candle. All right, so we have that. That is, again, a must. Okay, so is this a high probability bounce trade? So let's take a look at what we've been through. So first, stochastics. Okay, so again, when we're going long, we want the stochastics to be below 30 at the reversal candle. So let's check it out. Okay, so this is the reversal candle, right? The candle that bounces off the moving average. And at this point, we want both the lines to be below 30. Can you see they're both below 30? Right? Or it could be recently below 30 and it's crossing out from below 30, where the percentage K, in this case, the brown line is above the percentage D. Okay, so it's either below 30 or recently below 30 and it's crossing above 30, and that's fine as well. So that checks our first box, right? So stochastics is oversold. We've got that. Next, when we're going long, ensure that MACD 50, 109 is bullish. Or if it is bearish, it did not cross bearish in less than 5 candles. So let's check it out. You can see that the MACD over here is bullish. Okay, you can see the MACD line, the black line is above the red line, so it is bullish. So that checks our second box, right? So the first one is there, second one is there. Next, we have a wave pattern. So when we're going long, we want to see an uptrend wave. We want to see that the candles are making higher lows. In other words, the bounce candle is making a higher low than the previous swing low candle, right? So let me explain that again. Okay, so this is the reversal candle, right? So again, the reversal candle is the candle that bounces off the moving average. So we also call this a swing low. So this swing low must be compared with the previous swing low. This and this, right? So this swing low must be higher than this swing low, right? So that is higher. So we've got an uptrend wave pattern, as you can see. An uptrend wave is one that makes higher lows. That's what we want to see. Okay. Next, smooth retracement, right? When we're going long, we want to ensure that the price is making lower highs and lower lows before the reversal candle. So again, what it means is that before this reversal candle, right, you see the candles, this is known as the retracement wave. So ensure the retracement wave is smooth. What do you mean by smooth? The candles are making lower highs, lower highs, lower highs, lower highs, lower highs, lower highs, and lower lows. So it's a smooth retracement. Okay. Let me show you an example that is not a smooth retracement. Okay. So for example, yeah. So this is not a smooth retracement. Okay. Why is this not a smooth retracement? Because it makes lower highs, lower highs, lower highs, and then it makes higher highs, lower highs. So you can see that this is known as a pivot point, right? So before the bounce, imagine this is the bounce, okay? Before the bounce, we want to see lower highs and lower lows. We do not want to see higher highs and higher lows. So that's what I mean, okay? So let's go back to that 29th of that's one, okay? So you can see a smooth retracement there, smooth, okay? Next, strong support. So we want to see either one of these three conditions. So the moving average that is being bounced must be tested before at least 2 times prior to the bounce. And it must be, what I mean by tested 2 times means tested by at least 2 candles prior to the bounce. Or it's at a Fibonacci level, or the bounce is at a strong horizontal support or a resistance for shorts. Okay, so let's check it out. You can see that, has it been tested before? Okay, so it's tested once and tested twice. Okay, so there's 1 test, there's 2 tests, and this is the bounce. So it's been tested twice before. Okay, so the first condition is met. Okay, what else do we have? The sector or the industry trend must be bullish. So in this case, DNKN, which is Dunkin' Donuts, is in the restaurants industry. So we want to see that the restaurants industry is on an uptrend, right? So this is the uptrend pattern, you can see, uptrend, and it's above the 50 moving average. So that gives us the sector or industry trend is bullish as well, okay? And of course, the overall S&P 500, the market should be in a bullish mode as well for the highest probability, okay? So once we have got all those conditions, that makes it a high probability setup. We put our buy order, right? Place our buy order a few cents above the high of this candle, okay? Which is about 57 something. And we can put a stop loss below the a reversal candle or below the confirmation candle, right? Either one. But again, your stop loss distance should be at least 1 ATR, more than 1 ATR, and less than 1.5 ATR, right? So you can see that this was a successful trade over there. Okay, let's take a look at a couple more examples. Another one is LMT. Okay. So here's another example, and this was on the 8th of December. All right. So let's take a look. Is this a high probability setup again, based on our rules? All right. So what is the first rule? Stochastics. Again, we're going long, so stochastics must be below 30 at the reversal candle. So where's my reversal candle? Okay. So this is the reversal candle, this one. Okay, so this is a two candle trade through pattern. Okay, two candle trade through, and that's the confirmation candle. Okay. Okay, so at the reversal candle over here, you can see that again the stochastics is below 30. There we go. Right? Stochastics below 30. So again, it is either below 30 or recently below 30 and crossing bullish. In other words, the percentage K, the brown line crossing above percentage D. So that meets our first criteria. Okay. Next, MACD for long trades must be bullish or not cross bearish recently. All right. So you can see that the MACD is bullish. It's bearish, right? Because the MACD line is below the signal line, so it is bearish. So like I said, it must be bullish, or if it is bearish, it must have crossed 5 candles or more ago. So you can see that it crossed bearish over here, and it's definitely more than 5 candles to where we are entering. So that meets the second criteria as well. Okay. Next, wave pattern. So when we're going long, again, uptrend wave, price is making higher lows or moving average tested before. Okay, so this swing low, right, the reversal candle must make a higher low than the previous swing low. Okay, so this low is higher than this low, right? In fact, this low is also higher than this low, so we have got an uptrend wave pattern. Okay, and in fact, the moving average has been tested before as well. So that again meets the next criteria. Okay, so we met first criteria, second criteria, third criteria. Next, smooth retracement. Do we have a smooth retracement? Okay, let's check it out. Again, prior to the reversal candle, which is here, prior to the bounce, do we have a smooth retracement? Again, smooth retracement means candles making lower highs, lower highs, lower highs, lower highs, lower highs, lower highs, lower lows. It's a smooth retracement. Okay. Now over here you can see this is not a smooth retracement. Not a smooth retracement. This is not a smooth retracement. This is a smooth retracement. Because you can see that it made lower highs, and then higher highs. So it's not a smooth retracement, right? This is a smooth retracement. So ideally you want a smooth retracement before the reversal candle appears. Just before the reversal candle appears, right? Next, strong support. So again, moving average must have been tested before at least twice by at least 2 candles, or again, Fibonacci level, strong horizontal support. So let's take a look. So in this case, before the bounce, it was tested once, twice, 3 times. All right, so it was tested again more than twice before that, so that's fine. Okay. Next, the industry or the sector is bullish. So you can see that this is in the aerospace and defense, and again, it's on an uptrend. Right? You can see the price is on an uptrend, the industry on an uptrend above the 50 moving average. So again, this is a high probability trade. You can place our buy order above the high of this candle, and the stop loss can be placed below the confirmation candle or below the swing low candle, right? So again, you can place a stop loss anywhere from here to here. ensuring the stop loss distance is more than 1 ATR but less than 1.5 ATR, right? So you can see that this was again another winning trade, right? Okay, let's look at another example. Let's look at ABT on the 12th of December. Okay, so there we are. Okay, so ABT. So you can see that this is the 2-candle reversal, right? 2-candle reversal with a confirmation candle. So that's a valid 2-candle reversal pattern, right? And that's the confirmation candle. Okay. So does this meet the criteria? Let's take a look. So first of all, stochastics again. At the reversal candle, stochastics is below 30. So that's great. MACD, is it bullish? No, MACD is bearish. As you can see, MACD is bearish, but it crossed bearish a long time ago, more than 5 candles ago. So that's fine. Okay. Wave pattern, is it making higher lows? Okay. So this swing low, this is a swing low, right? And this is the previous swing low. Okay. So this swing low is higher than this swing low, right? So it's making higher lows. So that meets the criteria as well. Okay. Next, smooth retracement. We have a smooth retracement prior to the reversal candle, right? So it is a smooth retracement, very smooth. You can see the candles are making lower highs, lower highs, lower highs, lower highs, lower highs, lower lows. And the confirmation candle is the first candle that makes a higher high. And that's what you want. You want a confirmation candle to be the first one to make a higher high. Okay? So this is not a smooth retracement, for example. Okay? That's a smooth retracement. Okay? Next, do we have a strong support? Okay? Has the moving average been tested before? Has it been tested before? You can see yes, it has been tested before, right? So the 50 has been tested to be reliable here. That's one. And you can also say that before the reversal candle, it has also been tested. So it's been tested, many times. 1 time, 2 times. It's been tested 1, 2, and even 3 previously before that. So it's been tested multiple times. So that gives you a strong support as well. All right. So again, we could put a buy order over there, stop loss over there, and yeah, this turns out to be again a very nice trade. Okay, let's take a look at some more examples, different examples. Let's take a look at. Let's see. LOXO, 13th Feb. It's the trigger. Okay, so here we are. Okay, so this LOXO, we have got a single candle reversal, which is a bullish pin with a confirmation candle. Okay, so this is a valid single candle reversal setup. Now it is also a 2-candle reversal, right? So this could also be considered a 2-candle reversal with a confirmation candle, right? So again, let's check it out. Do we have at the reversal candle, it's a stochastics below 30. Is it below 30? Right? So you can see that it was recently below 30, both lines below 30, and it crossed above, or it crossed bullish out of the oversold level. So percentage K crossing above percentage D, so that's valid. All right, so that's valid. That's cool. Next, MACD. Is it bullish or not cross bearish within 5 candles? Let's check it out. Okay, so you can see MACD is bullish, right? The black line is above the red line, so it's bullish. So that meets the second criteria. Next, do we have an uptrend wave pattern? The reversal candle making a higher low compared to the previous swing low candle, right? So again, you can see that this is a swing low, and this is the previous. This could be a previous swing low as well. Could be here as well, right? So yeah, this is making higher lows. So this swing low is higher than this swing low, and you can say that this swing low is higher than this swing low. So it's making higher lows, right? So that's reliable. Excuse me, right? Next, we have a smooth retracement. So we have got all these checked. Okay, smooth retracement. Let's check it out. We have a more or less smooth retracement over here. All right. So more or less, price are making lower highs, okay, and lower lows. Okay. So that's a smooth retracement. Next, does it have a strong support? Okay. Now, has the moving average been tested before, at least twice? In this case, it is testing the 50 and the 100 moving average. So has it been tested before? Not really. So the moving averages have not really been tested before, because you can see it broke below the moving average. It broke below the 50. It broke below the 100. So it has not been tested before, right? So, but is it a Fibonacci level? So it does not meet the first criteria, but is it a Fibonacci level? All right, so to check it out, let's check if it's a Fibonacci level. So I'm going to use my Fibonacci tool, and if you take this as A to B, right, this A to B to C, you can see that it's a 61.8 Fibonacci level. So this is a Fibonacci level that gives me confidence that it is a strong support. Right. So it meets the second criteria here. All right. Finally, you can see the sector or industry trend is bullish. Right. Biotechnology is making, now if it goes below the 50, it's still okay, as long as you can see it's making higher lows and the moving average is still sloping up. So it is still considered a bullish industry pattern, right? Okay, so you can put the, again, buy order over there, stop loss over there, for example, and you can see that this turned out to be a winning trade as well. So let's now take a look at a slightly different example, which is the 18 EMA bounce. Okay, so you can see that the LII is bouncing off the 18 EMA. So remember that for the 18 EMA bounce, it's a bit different. For the 18 EMA bounce, it must be tested before. Okay, so the 18 EMA is not as strong a support as the 50 or the 100. So because of that, we must ensure that the 18 EMA has been tested before. And for the 18 EMA, we use two MACDs. We use the MACD 50-109 and the MACD 1859. Okay, and both MACDs must be bullish if it's an 18 EMA bounce. So this is a special criteria for the 18 EMA bounce. So once again, let's take a look at our checklist. So first of all, stochastics again. So where's the reversal candle? So this is the reversal candle over there. And this is the confirmation candle that's bouncing off the 18 EMA. So once again, you can see that at the reversal candle, okay, stochastics is below 30. Okay, so that meets the first criteria. Next, MACD, 50, 109 and 1859 must be bullish because it's an 18 EMA bounce, which I just mentioned. So you can see that both the MACDs are bullish, right? They're bullish, they're bullish. The black line above the red line, black line above the red line, stochastics is oversold over here. So next, wave pattern, right? Do we have a wave pattern? The reversal candle must make a higher low than the previous swing low. So this is the swing low, and this is the previous swing low. Okay, so again, it's making a higher low. So it's an uptrend wave pattern, right? So that confirms it. Next, do we have a smooth wave pattern? Sorry, a smooth retracement, right? So ideally, before the reversal candle, we want to see a smooth retracement. And we can see a pretty smooth retracement here, right? Candles are making lower highs, lower highs, lower highs, lower highs, lower highs, and lower lows, okay? Strong support. So the moving average must be tested at least twice before. So in this case, you can see that it was only tested once. It was not tested twice. Okay, so it doesn't meet does not meet this first criteria. So does it meet the second criteria? Is it a Fibonacci level? All right, let's check it out. So let me just remove this so it's a bit cleaner. So if I use my Fibonacci tool, I could take this as A, B. Okay, so this is the A, start of the impulsive wave, B, end of impulsive wave, C, end of corrective wave. So again, you can see the C is at the 61.8% Fibonacci level. So that is a Fibonacci level, and that makes it a strong support. So again, I could put my buy order over there, stop loss over here, all right, and then you can see that it's also a pretty decent trade. Okay, so let's take a look at some short examples. The first one is TEP, and this is a bounce short setup on the 21st of February, all right? So you can see over here, a two candle reversal pattern with a confirmation candle bouncing off the 18 EMA. So again, let me just highlight that this is this one over here. That's the reversal candle, and this is the confirmation candle, right? So again, notice that this is a special case because it is bouncing off the 18 EMA. And the 18 EMA is not as strong as the 50 or 100. So because of that, for the 18 EMA bounce, you must always ensure that it was tested before. So you can see that it's been tested before. The 18 EMA has been tested to be strong, okay? And both MACDs, right? For 18 EMA, we use the MACD 50, 109 and MACD 1859. And both MACDs must be bearish when we're going short, right? So this is bearish, it is bearish. Okay, because both of them are, the black line is below the red line, okay? The MACD line is below the signal line, okay? So let's again take a look at our criteria over here. Stochastics, now that we are going short, stochastics must be above 70 at the reversal candle. So you can see that, again, at the reversal candle, we have the stochastics. Let me just use this. Okay, stochastics is above 70, right? So both the percentage K and percentage D are above 70. Okay. So that meets the first criteria. Next, MACD. For short, MACD must be bearish, okay, or not cross bullish within 5 candles. And again, because it's a 18 EMA, they must both be bearish. You must look at 2 MACDs instead of 1 MACD. All right, so again, I've mentioned that they are both bearish. So that meets the second criteria. Next, wave pattern. We want to see a downtrend wave where the reversal candle is making a lower high from the previous swing high. Okay, so this is the reversal candle. It's a swing high, that's a swing high. So this swing high is lower than the previous swing high. So it makes lower highs. Remember, for a downtrend wave, it must make lower highs. So that satisfies the criteria. Next, do we have a smooth retracement? So again, for short trades, the price should be making higher highs and higher lows prior to the reversal candle forming. Okay, so again, you can see a smooth retracement before the reversal candle. So again, smooth retracement means the candles are making higher highs and higher lows. And again, the reversal candle is the first candle that makes a lower high and lower low, right? So it shows that it is turning around. Okay. Next, do we have a strong support, or in this case, for going short, do we have a strong resistance? Okay. So for strong resistance, ensure the moving average has been tested before, at least 2 times, or the resistance or support is a Fibonacci level, or it's a horizontal support or resistance. So in this case, how many times has it been tested? It's only been tested once actually, before the reversal candle. So only tested once. So do we have a Fibonacci level over there? Right. So if you take this to be A, B, and that is C, right? So taking Fibonacci, click on A, drag to B, and you can see that this over here is the 61.8% Fibo level, right? So it has a strong Fibonacci resistance, so that is a valid trade as well. Okay, so again, you can place your sell order below the low of the candle, your stop loss above the high, and you can see it went down, and yeah. Okay, another short example, SXT. On the 20th of February, we had a short setup. So you can see over here, right, there's a 2 candle reversal pattern bouncing off the 50 moving average with a confirmation candle over there. So again, this is the reversal candle, and that's my confirmation candle. All right. Okay, so let's see again, does it meet the criteria? You guys should be experts by now. First, stochastics. Again, for short trades, stochastics should be above 70 at the reversal candle. All right, so there we are. At the reversal candle, we are above 70 on the stochastic. So that's overbought. That's valid. Next, MACD. For short trades, MACD must be bearish or not cross bullish recently. So MACD, as you can see, is bullish. Sorry, it's bearish. Right? You can see the MACD line in black below the signal line in red. So it's bearish. Check. Stochastics above 70. Check. Okay. What's next? Wave pattern. Again, we want to see a downtrend wave where the reversal candle swing high is making a lower high than the previous swing high. Right? So this is a swing high. This is the previous swing high there. Okay, so this high is lower than this high. So again, on a downtrend, you want to see a downtrend wave, lower highs. Okay, so it's making lower highs. Next, do we have a smooth retracement? Again, for short trades. Okay, for short trades, the price making higher highs and higher lows just before the reversal candle. Okay, so again, you can see smooth retracement prior to the reversal candle, right? Price making higher highs and higher lows, smooth retracement. Okay, next, does it have a strong support, or in this case, a strong resistance? Okay, so again, moving average must be tested at least twice, or again, the resistance or support is a Fibonacci level or a strong horizontal support resistance. And finally, again, the sector or industry is bearish for shorts. So let's take a look at all of that. This is the industry, specialty chemicals. You can see that it is on a downtrend, right below the 50 moving average. So industry is on a downtrend, that's fine. So is this a strong resistance? Has it been tested before? Okay, so you can see it's been tested, once, twice. In fact, you can also count this as 3 times. So it is a strong, reliable resistance level. Okay, so there we go. This makes it a high probability trade. So entry over there, stop loss over there. Now let's look at what happens to this trade. So the next day, the trade triggers and gets stopped out. Yeah, so this was a losing trade. In fact, it hit the stop loss in 1 day. Okay, and you will come across trades like that where, okay, it meets all the rules. It looks like a great trade, but it's a losing trade. All right. So at the end of the day, remember that a good trade is one where you follow the rules, and a good trade can end up to be a winning trade or end up to be a losing trade. But it's fine, because as long as you keep taking good trades, you have more wins than losses in the long run, and you will make money. Okay, and sometimes people get upset because they get stopped out in 1 day. I don't know about you, but if I have a losing trade, I like to hit my stop loss immediately, because if I'm going to die, I like to have a quick death, right? So that I can quickly move on to the next trade and not have the trade linger for days and then get stopped out after a few days, right? So this was one of those where it was a losing trade, but it's a trade with no regrets. I was happy I took it because I followed the rules, right? So I hope you've got a pretty good idea now about how to identify high probability bounce trades. And that when you take a look at the trades that you take, as long as you take these high probability trades, the odds will be in your favor. It's Adam Khoo. You got questions, send me an email. Happy trading, and may the markets be with you.